Welcome back to the very interesting session called Liquidity Concepts. Today we will discuss liquidity because, as you guys know, the market is driven by liquidity. Without liquidity, the market doesn't move. Liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. As you guys know, we have retail patterns, as you can see on the diagram. People often go to Google and search for these patterns, and they find double bottoms, triple bottoms, double tops, triple tops, and all of these patterns. You can find them on sites like babypips.com or learn them from many other sources out there. However, these patterns usually do not work in real trading. They are often not useful and can be misleading in actual market conditions. Before we go to the example, I want you to know something important. When someone wins in Forex, someone else is losing. The money lost goes into a big pool. The winners take their profits from this pool. The tool used to highlight the zones of liquidity areas in Forex trading is this one, as shown in the diagram. Let us take a bearish example. As the market is printing lower lows and lower highs, we see a double bottom below where the liquidity is sitting, as highlighted in the diagram. Our goal is to target that liquidity. As we know, our strategy is supply and demand. You can see on the diagram that we have a supply zone and another supply zone below that where the price has tapped now. We are looking for shorts, or we can say sells. The market is still in a bearish structure. There is nice liquidity below, as I have highlighted. So we are looking for shorts from the second supply area. After the price taps into the supply zone, it will take the liquidity sitting below. After the price takes the liquidity, this liquidity area will become a break of structure to the downside. We then have to wait for the market to complete the correction phase. Once the market comes into the new supply zone created, and after tapping that supply zone, the market will fall again and break the new low once more. Now let us take a bullish example. The market is printing higher highs and higher lows with two break of structures to the upside and a double top on the top where the liquidity is sitting. Our goal is to target that liquidity, just like I showed in the bearish example. Again, as our strategy is to trade supply and demand, you can see on the diagram that we have a demand zone here and another demand zone above that where the price has tapped now. Here, we are looking for longs, or we can say buys. The market is in a bullish trend, and we have nice liquidity to target. So, we are looking for longs from the second demand zone to take off the liquidity sitting there. After the price takes the liquidity, this liquidity area will become a break of structure to the upside. After that, we have to wait for the market to complete the correction phase. Then the market will come into our new demand area. After tapping into that new demand area, the price will go higher and break the new high. This is how liquidity works in trading. Stay persistent and dedicated. Every step you take in understanding these concepts brings you closer to mastering trading. Remember, every great trader started where you are now. Keep refining your skills, stay disciplined, and success will follow. Keep up the hard work, you're on the right path. Then we have something very interesting. Consolidation in the middle of a bullish trend. The market has pushed up with huge imbalances and a break of structure. After making the high, the market starts moving sideways, manipulating retail traders. The key is to wait patiently for the market to tap into our demand zone. This consolidation between our demand zone and the high is known as a liquidity pool, where many retail traders lose their money. We should take our trade when the market taps into our demand area, and then it will break the high or go higher. Now let's talk about the bearish scenario, consolidation in a bearish trend. The market has broken structure to the downside and left huge imbalances. After making the low, the market starts moving sideways, manipulating retail traders. The key is to wait patiently for the market to tap into our supply area. This consolidation between the low and the supply area is called a liquidity pool, where many traders lose their money. We should wait for the market to tap into our supply area, and then it will break the low, which is our target, and could go even lower. These two concepts are called liquidity in consolidation or sideways market. Now let's jump to relative equal highs and relative equal lows. This means when the price creates almost a double top, but not quite, and then comes down as shown in the first diagram. Notice at the top where I've highlighted the equal highs, which means liquidity is still sitting there. The same concept applies to relative equal lows in the second diagram. See how I've highlighted the relative equal lows in the second diagram. In both of these scenarios, relative equal highs and relative equal lows, the price should not break the first high in the first diagram and the first low in the second diagram. These are encircled in both diagrams to help you understand better. This was just an introduction to liquidity on diagrams. We will go through liquidity concepts in more detail later. For now, we've covered the bullish example, the bearish example, consolidation, double bottoms, double tops, relative equal highs, and relative equal lows. In the next videos, we will look at good examples and discuss more liquidity concepts, including trend lines and more. Study hard and enjoy the content. Bye.